US home sales jumped 4.2% in February, and that surprised a lot of people. But here's the thing, it's not because the housing market is suddenly booming. It's because people have finally accepted that this is our new normal. Mortgage rates are hovering between 6 and 7%, prices remain high, and affordability is still near historic lows. Yet people are buying again. Why? Well, stick around for a bit and let's talk about what's going on in the housing market right now, how we got here, and why so many people feel like they're stuck. And if you're new here, hit that subscribe button below. It's free and it does a lot to help out the channel. So let's start with the numbers. In February, existing home sales climbed to a seasonally adjusted annual rate of 4.26 million. That's a big jump from the month before and way better than what economists were expecting. For those that aren't familiar, that phrase seasonally adjusted annual rate, it just means that they're taking the monthly sales and adjusting for typical seasonal patterns, then projecting that as if it were the trend for the entire year. It kind of helps smooth out the noise and see the bigger picture. But don't let that headline about home sales fool you. Compared to a year ago, sales are still down 1.2%. And overall, 2024 actually saw the lowest level of home sales since 1995. Yes, even lower than during the fallout of the 2008 financial crisis. That might seem surprising given how severe that downturn was, but the drivers in 2008 were very different from today. Back then, we saw a collapse in credit, widespread foreclosures, and a massive oversupply of housing. Today, it's almost the opposite problem. There's very little inventory, mortgage rates are high, and homeowners are locked into low-rate loans that they don't want to give up. Most people aren't selling homes, and many can't afford to buy. The result is a frozen market, where demand exists in theory, but the math just doesn't work out for most families in practice. So why are people buying homes when prices are still high and borrowing is expensive? Well, life doesn't stop. People are still getting married, having kids, relocating for work. At some point, they just decide to bite the bullet. It seems that the shock that came with the rate hikes in 2022 is starting to disappear. Buyers have given up hope that rates will return to 3%, and they're adjusting their expectations. In economics, this behavioral shift is sometimes referred to as adaptive expectations. Consumers are beginning to accept new economic conditions as the norm, even if those conditions are significantly less favorable than just a few years ago. Rather than waiting endlessly for a return to lower rates, buyers adjust their mindset, their budget, and their decisions based on the reality in front of them. It's not about giving up, it's about adapting to a changed financial environment. But regardless of consumer mindset, the problem of affordability remains. The median existing home price in February was $398,400, a record high for February. Add in a 6.67% mortgage rate as of mid-March, and you get a monthly payment that feels unsustainable for most first-time buyers. Beyond just home prices and interest rates, something that a lot of first-time home buyers forget to factor into their affordability calculators are property taxes and insurance premiums, which tend to scale with the value of a home. So when home prices rise, those costs rise too. Even if a buyer can technically afford the monthly mortgage payment, they might find themselves financially stretched once you factor in an extra few $100s a month or more for taxes and insurance. In high-cost markets, this can push a seemingly affordable home into unaffordable territory. It puts buyers in a tough position. They qualify on paper, but the reality of monthly expenses can be overwhelming once everything is added up. On the seller side, a lot of them are sitting tight. If you bought a house when rates were 3% and your monthly payment is low, why would you sell and take on a new mortgage at twice the rate? That lock-in effect is keeping inventory low, which puts even more upward pressure on prices. Another important measure to keep in mind is the case-shiller home price index. This index tracks the price changes of single-family homes across major U.S. cities. It's considered one of the most reliable gauges of home price trends because it uses repeat sales data. That is, it compares the prices of the same properties over time rather than just median prices. The March update showed that in January, we saw a 4.1% increase year over year, which reflects how resilient home prices have remained even as mortgage rates have gone up. This kind of steady appreciation is part of why affordability continues to be such a pressing issue in the market. That said, you might be interested to know that much of the activity we've been seeing is actually driven by the higher end of the market. Sales of homes priced above $750,000 rose compared to a year ago, while sales below that price point declined year over year. Speaking of wealth, let's talk about what the pandemic did to this market. During the pandemic, we saw a once-in-a-generation housing boom. People moved across the country, often on a whim, chasing space, scenery, or just a change. Some bought early and locked in ultra-low rates. Others tried to time the market and got burned. Now, 5 years later, we're living with the aftermath. Remote work made it easier for people to live wherever they wanted, but it also pushed up prices in previously affordable areas. This brings us to one of my favorite economic concepts to talk about, the illusion of money. Let's say back in 2018, a modest 2-bedroom, 1-bath home was worth $150,000, while a larger 4-bedroom, 2-bath home was worth $300,000. Fast forward to today, and let's say both homes have doubled in price thanks to the pandemic-era housing boom. That 2-bedroom house now sells for $300,000, and the 4-bedroom house is sitting at $600,000. At first glance, it looks like the family living in the larger home just made $300,000. But here's the catch. They still only own one home, and it's the same home they've always had. If they sell it, they'll need to buy something else at today's inflated prices. And unless they're downsizing to that smaller $300,000 house, they're not actually gaining very much. This is the illusion of money. Valuing wealth in nominal terms, not in real inflation-adjusted terms. Housing wealth feels real on paper, but unless you cash out and dramatically change your living situation, the gain is mostly theoretical. You're still paying higher taxes, higher insurance, and potentially higher maintenance costs on a now more expensive asset. It's a good reminder that just because your home is worth more, that doesn't mean you're richer in any meaningful way, especially if all other homes around you have appreciated just as much. I feel like a lot of people don't have a solid grasp on this concept and tend to focus on the equity value of their home without realizing that the price didn't just appreciate in a vacuum. On the construction side of the market, things aren't looking much better. Builders are facing high input costs, labor shortages, and uncertain demand. Now, new home starts did rise 11.2% in February. And just to clarify, new home starts refers to the beginning of construction on new residential buildings, which is a key indicator of builder confidence and future housing supply. But despite that rise, permits for future construction fell 1.2%. Tariffs on materials, fears of recession, and policy uncertainty are all weighing on builder sentiment. Even companies that supply the housing industry are feeling the chill. Some big players are merging, not because they seek growth, but because they need to survive. It's like they're huddling together for warmth through a cold winter. So where does that leave us? Well, the bottom line is this. I don't think the housing market is crashing. I think it's just stuck in a weird in-between space. Rates are high, prices are high, and inventory's low. That's a recipe for frustration, especially if you're trying to buy your first home. So here are my key takeaways. Guys, this might be the new normal. Barring some major economic shock, I don't think we're going back to 3% mortgage rates anytime soon. Second, affordability is the main problem. Until income catches up or prices cool off, the dream of homeownership is going to stay out of reach for many. Third, sellers are staying put. The lock-in effect means fewer homes on the market, which props up prices. And lastly, builders are cautious. High cost and uncertain demands are making it harder to ramp up new construction. In closing, buying a home in 2025 isn't impossible, but it sure isn't easy. If you're in the market, you need to be prepared, flexible, and realistic about what you can afford. But also, if you're on the sidelines, know that you're not alone. Plenty of people are waiting for the right time, and that might be the best thing for some of you right now. Don't let what everyone else is doing cloud your judgment and put you in a tough financial position if the timing isn't right. The timing will be right one day. So what do you think? Are we stuck in a permanently unaffordable housing market, or are things going to start cooling off? Let me know in the comments, and if you got value from this video, don't forget to like and subscribe. I post a new video every weekday to keep you up to date on what's happening in the world of finance. And until next time, have a good one.